We're a little less than 2 hours before the open on Wednesday, October 6th. Hello, traders. I'm going to get an early start today. We got the S&P futures down about 50 points before the open today. So nasty selling, and I want to show you my blog from yesterday. Headline: the market still has more downside. Here are the warning signs. You can get my comments at oneoption.com. Use the number 1. This is my blog. In the description of this video, you'll also see a link to my Twitter feed. So I'm going to click on this, and you'll see that my pre-open market comments, which are free, are extensive, and I go through some of the problems that I see forming right now. So heading into the day, I'm going to go into my chat room and I'm going to show you how my market comments started out yesterday. And you'll see that initially I am very bearish. I'm fairly bearish, as you can see from my comments. I'm going to scroll down. I want badly to short the market, but I'm not going to. Instead, I'm going to wait for the 10p to rally, and I'm going to evaluate the price action during this bullish cycle. Those clues will provide me with the confidence I need to enter the trade, and my patience could provide me with a better entry price. So let's start there. And by the way, I am going to have a bearish trade for you throughout the course of the video, so please be patient, and let's take a look at what unfolded yesterday. So we've got this gap up, and I'm going to tell you why I am longer term bearish in a few minutes. But I am bearish as heck, and we get this gap up. At this point, I am looking for a gap reversal. I do not trust what I see in the market. Get a little bit of a doji here, nothing too damaging. The market's still kind of waffling around, and then we get a nice long green candle closing on the high. We have a bullish 10p cross that extended from the close on Monday, and you can see how positive it is. 10p heading higher, market should be heading higher, and yes, these two are consistent. Can I just jump in and go, hey, 10p is bullish, long green candle, buy them? Yes, I could with that type of confidence in my indicator. However, my bearish market bias prevented me from doing that. And it's okay, because that brings up a couple of points. First of all, I was bearish here, but I was not going to act on it until I had price confirmation. What would I need to see? Long red candle closing on its low, long red candle closing on its low, long red candle closing on its low. If I got 3 of those in the first half hour with very little retracement, that would tell me that we are in trouble and the market is going down, and we are going to be taking out the low for Monday. That didn't happen. Also, the 10p indicator is keeping me sidelined. Good thing, because I would have been on the wrong side of the market, and I would have had my head handed to me. So be very, very patient when you're trading the S&P 500. One thing that most traders want to do, especially novice traders, is they feel like they have to catch every single move. If I don't catch every move, I'm not a good trader. And they look back and they try and rationalize, why did I miss that move? Was there something I should have picked up on? Those are good exercises to go through, but in the end, you really have to have staying power and confidence in your position to be able to ride out some of the volatility. In this particular instance, I do not like the market backdrop. I don't mind if I'm going to miss this move, because I know at some point through the course of the day, be it buying a pullback or shorting a rally, I'm going to have my opportunity to make my money. And when I do that, I'm going to have a ton of confidence taking that position. So those are things that are really important to keep in mind. The other thing that I hear from a lot of people is, how do I know when to enter? How do I know when to exit? What are the indicators? What are the signs? Ultimately, everyone is looking to buy the low of the day, and they're looking to sell the absolute high of the day. The sooner you come to grips with the fact that you will never buy the low and never sell the high, the better. Your best trade is going to happen not here, because you don't know what the market's going to do. Are we going to get a gap reversal? So far, this looks like the market wants to drift lower. And if you start shorting here, you get your head handed to you. So you need to wait patiently for the market to tell you what the heck it's going to do. So in this particular case, what ended up happening is I went through a play-by-play and I started describing all the price action. But in the chat room, I also, once I got about the first hours worth of price action out of the market, I had told everybody, I think this is what's going to happen. I think that we are going to run up, establish the high here, and then we are going to compress in a very tight trading range the entire day. Why did I feel that way? Because look at this move. Gap and go. Run up, make the whole move in the first hour or very close to it, and then do absolutely nothing the rest of the day. Where have I seen that before? Gap down, sell off hard, compress the entire day. That was the price action that we saw on Monday. So between the 2 days, big sell off early, big rally early. These two moves negate each other. The rest of the day we spend flatlining. Let's go into the daily chart because these are the important clues. And this is why I was very bearish on the price action. So we get this sell-off here on Monday and the market could not rally. So near the close Monday, I told everyone, there are a couple of ways to see this price action. Bulls will be happy because they were able to stop the bleeding early. And look, the sellers were not able to knock the market down any further. That's a victory for us. On the other hand, bears will look at this and say, hey, wait a minute. Look, we knocked the market down and the bulls were not able to rally the market. They couldn't get it off the deck. Every time they tried to rally it, it was like whack-a-mole. Wham, wham, wham. Just kept knocking it down. That's bearish. I view this price action as bearish. Let's go into the daily chart and I'll explain why. Every single little dip that we've seen has been bought. So if we put the major moving averages up, we can see where that support has come into play on the 50-day moving average. Hardly any selling, then bam, right back at it. Hardly any selling, couple days, 3 days worth, and then long green candles off of that low. So the dip buying has been very prevalent. That is aggressive buying, and it tells you that the market bid is super strong. These sell-offs could barely even get going, and buyers were so aggressive they were gobbling up everything they could get. That's not what we're seeing here. This is persistent selling that's lasted 2 weeks, and look, we closed below the 50-day and then got this big drop down to the 100-day. Nice little bounce in here. I expected a bounce because that's what's been happening. So you get a major moving average that tested. You got this bounce up to the 50-day. Okay, this is a pretty good entry point on a bearish flag formation. So we did catch that move from last week, but look, not only did we sell off hard, we hit the 100-day moving average. What would I normally expect out of this type of price action given what has happened earlier in the year? I would expect to see a candle like this. We come down, we touch it, and buyers are so excited because they finally get a second chance to reload that major support level that they've been waiting for a double test of that's finally happened. Buy, 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 buy. If we would have seen this candle right here, we would have had a double low and a higher low off of a major moving average, then we would have been making an assault on that 50-day moving average. That's not what happened. Instead, we get this doji, so all these losses are preserved, and then the next day we tank and we close below the 100-day moving average. So the last few days you can see how we have not been able to get through that 100-day moving average. That is why I am bearish. So we get that big sell-off on Monday with a close near the low, and then Tuesday, which there's a little bit of an anomaly, there's something called turnaround Tuesday. Oftentimes you will see a reversal on a Tuesday, and there we go. You can see how Tuesday was just nice, but it was a one-off candle, and look where it hit resistance at that 100-day moving average, and it backed off of it. So now we've got 2 consecutive closes below the 100-day moving average. This morning, the S&P 500 is down 50 points, so we are going to be testing these lows this morning, and we're going to get continuation on the downside. We cannot buy this market until we get a massive washout. Look at this candle here. It'll be even bigger than this when it happens, but you're going to hit an air pocket. Buyers are going to completely step back and they're going to say, hey, listen, I don't want to have anything to do with this market right now because I think that I'm going to be able to buy at lower prices. You have all other asset managers who are in risk off mode. Risk off mode means that they are natural sellers. They want to unload some of their stocks. That's what keeps a lid on the market. They're not bearish speculators. They are trying to exit their stock positions. That keeps nice, consistent, heavy selling pressure on the market. So when I refer to natural sellers, that's what I'm talking about. So in any event, we've got this lid that's kept on the market. Monday, we get a little bit of a relief rally in here, which, by the way, if the debt ceiling gets extended, which I expect that it will, we could see a day where there's a relief rally as well. So you've got to be a little bit cautious with your bearish plays in here. Just know that you're going to have to weather one day where the market will probably rally on that news, but it'll be very, very temporary, one and done type of day. So in any event, we've got this heavy selling pressure. We are now closing below the 100-day moving average for 2 days straight. So as I go into my market comments, I'm going to show you that I did finally make my money yesterday. I'm going to put up the 10P indicator, and you can see here what it did through the course of the day. That was a nice bullish cross. Yes, you could stay bullish up until here. Now you've got to be a little bit careful because you know that there are signs that the market's getting a little frothy and that a pullback could be coming. We go through an entire bearish cycle normally. When it's down, you would expect the market to go down. When it doesn't, it is a sign that the trend strength is still strong. So you get a bullish cross in here, and everything continues to move higher for a while. But now in the afternoon, we're compressing, trying to make a new high for the day, unable to. And we get a bearish cross in 10P here, upward sloping trend line right through here. That was a key bar yesterday into the close. As soon as I got that breakdown on this bearish 10P cross, we were shorting here and I made my money. I just had to be patient. And I can't look at this and go, oh, you're such a fool. You missed this whole move. How could you let that happen? You don't have to catch every move. If you're trading S&P futures, and this is a very important lesson, all you need is one good trade a day. But when you make that one trade, it damn well better be good. And your hit ratio on that one trade better be north of 75%. So wait for that setup. You're going to see at least one really good setup a day, sometimes two or three. So being able to identify those is critically important to being able to trade S&P 500 profitably. What you don't want to do is you don't want to be in and out and in and out and in and out, and you look at the end of the day, you've had 30 trades. That's no good. That tells me that you have no conviction to the position and you're just willy-nilly going to get chopped out on every little head fake that happens. So let's go into the market again just a little bit and talk about some of the things that I see that I don't like. First of all, I described the selling pressure in our market itself, and I'm going to take this 10P indicator off and I'm going to put up TLT. TLT, US 20-year bond. Look at how TLT has broken down. In fact, I'm going to put that 200-day moving average up. So bonds down, interest rates up. That's what the price action tells you always. So when bonds are selling off, that means interest rates are rising. Higher interest rates are not good. It tells me that the Fed is going to have to start tightening pretty soon. And here we get a defined breakdown through horizontal support, through the 100-day moving average, through the 200-day moving average, and look, very important, market has not been able to rally through these major moving averages. Now that is resistance, and look, it's starting to break down. Yesterday was a very weak day for TLT. Now, while this is happening, I also was looking for a trade yesterday. I'm going to show you that trade in just a second. We have higher energy prices, and that is putting upward pressure on prices If you look at fuel costs, energy costs, that is one of the largest input costs that companies have. Even for food, you have to transport the food somehow. That means you have to have a truck, you have fuel expenses. Right now, India has a 4-day supply of coal. China is scrambling to get more oil and coal in. They have such huge energy shortages that they're having to ration electricity. That means that there are going to be even more supply disruptions than we've already seen. You've got ships waiting at port in China and the US, so goods are not getting to market. We've seen a contraction in China's economy. The PMI, the official PMI that came out last week, showed that China's economy is in contraction territory. Not good. Well, normally you could rationalize that higher energy prices are good because, and this is oil, it indicates that, hey, there's a lot of demand for oil. Demand for oil goes up when everybody is increasing production and when we have nice economic growth. That's not the case this time around. I wish it were so. It's simply not true because global economic conditions are starting to stagnate, and the issue is supply related. When you look at what happened during COVID, these oil companies had gluts of oil. They couldn't give it away. Oil prices actually went negative for the first time in my 30-year trading career. I've never seen anything like that before. So they capped these oil wells. Well, once you cap an oil well, you can't just uncap it. It takes a long time to get that production back online. OPEC is not doing anything to increase their production right now. They would like to see higher oil prices preserved for a while. You've got all these green initiatives. So coal production is down 40% in the United States. Power plants are wanting to shift over to more coal right now because they need it and it's simply not available. So my point to all of this is that the increase in energy prices is not demand driven, it's a supply issue. In any event, higher prices are inflationary. When you have inflationary pressures and economic conditions are starting to recede, that's called stagflation. That is very bad for the market. Is this just a temporary blip or is this something that is going to be sustained? We don't know. At the same time that you're having this, you've got credit concerns in China, along with a slowing economy and uncertainty related to what the heck China is going to do with their shadow banking industry, which is greater than $20 trillion. So, a lot of unregulated loans out there. This is a real mess that's brewing. This is China's market, the FXI. I've been pointing this out to you for quite a while. Why is their market in bear market territory? And there's the high from this year. And look at what China's market has done. This is supposed to be a global economic recovery that's taking place, and China's the growth engine for the world, and they've got about a 10-month head start on COVID. Well, why is their market doing this? Yes, there are regulatory issues in their high tech area, but this selling spreads way beyond those tech stocks. So let me get to the trade because I'm going to tell you why I did this trade yesterday right on the closing bell. And it's on VXX. And I still think that VXX will be a good opportunity even this morning. Let's zoom out on it so we can get a longer term perspective. Look at this. It is down right on the low. To me, this is a bargain. What is VXX? It measures the option implied volatility for the S&P 500 options. So if you have very, very low option implied volatility, then there is very little uncertainty. When do option premiums explode? When do those implied volatilities inflate? When there are times of uncertainty, and you get times of uncertainty during market decline. So nobody in here believes that we are going to see increased option volatility or market volatility for the foreseeable future. And because we've had 0% interest rates for a long time and we've had a market that's been grinding higher. There hasn't been a lot of market volatility for a while. So the most crowded trade in the world is to sell premium. Sell, 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 sell. All volatility, just sell it. Because we have 0% interest rates and the Fed's got their foot on the gas pedal, the market can't go down. The market's only going to go up because what are people going to do? They're going to flood into bonds all of a sudden where they have negative real returns. Bond yields don't keep pace with inflation. No, they're not going to go chasing into bonds. They're going to always stay in the market. And that's why you get a nice big market rally like that. Go into the weekly chart. You can see, look at this move right here. One of the problems with this move is that the S&P 500, from a forward PE standpoint, from a valuation standpoint, we have not seen stock valuations this high since the tech bubble of the year 2000. That's a bit of a problem. So those are all things that I'm taking into account. I'm trying to get all the macro information that I can, the fundamental information, so that I know what might be driving the decision making for asset managers. Once I have that, then I watch price. I always go off of what I see in price movement. So I'm not going to come in a particular day and go, oh my gosh, so and so on CNBC said that the market's going to sell off hard, or there's this fundamental reason or that fundamental reason, so this is a time to get short. I'm not going to trade off of that type of news. I am going to watch price. That's all I need to do. I don't follow the headlines and trade off of them. I'm aware of what the issues are, but I simply watch price. And the price right now tells me we are going lower. Market has been selling off. This is the most persistent selling that we've seen in the last year. Get this little bounce in here. We get our bearish flag. We're below the 100-day moving average for 2 days in a row now. Nice downward sloping trend line. GTC, click the high of that bar right there. Click the high of that bar right there. And you can see how this downward sloping trend line is firmly intact. The price action that we saw the last 2 days, this was just all fluff in my opinion. They couldn't drive the market down, so they thought they would rally it yesterday once they got the momentum going. They had this brief rally with some selling pressure at the end, but the tell for me was the fact that on Monday, the market sold off hard below the 100-day moving average and it could not get off the deck. Monday, near the close in the last hour, I told everyone, I think this is a bearish formation here, but I am not going to buy puts. Why not? I didn't buy puts because I feel that I have plenty of opportunities to get short because we have been in such a strong bull market rally that I'm going to have an opportunity tomorrow, given this price action. Bears not able to sell the market off hard, that we should see at least some type of little gap up, and then I'll be able to short here. I don't have to short here. I don't have to take the overnight risk. Let the market do what it's going to do tomorrow on the open. So yes, in here, I'm looking to short. I'm kind of excited because I've got a really good entry point in here. But then I see the long green candles, and I would be trading against my 10P indicator. Not wise. All of a sudden we get liftoff, and I'm like, that's actually okay. I might have missed this move right here, but what I'm going to catch today is this move because it's going to be pretty accelerated, and I'm going to show you my comments, and then we'll talk a little bit about the trade that we're going to do. You might have guessed, I'm just going to buy the VXX. That's what I did yesterday, and I did it in the last hour of trading. And you can see some of my comments. I'm just going to put up my chat room. And you can see that I'm getting into some of the things that I've been discussing to you now. Why was the market not able to get off the deck? Didn't mention this. Analysts are lowering their earnings projections, which earnings season starts next week. There, if you took the upgrades and subtracted the downgrades, that number is actually negative. So there are more downgrades than upgrades right now. And as we get into the close, you'll see that I ended up buying the VXX, and I believe I did that about 20 minutes or so. There's a gain that we took on the ES yesterday, and I wanted to have an overnight short position, and I've already been buying VXX in here. I can't, yes, I'm long VXX itself. I'm trying to find that entry point. And I'm sorry for the delay here. I'm always trying to validate that what I tell you I'm doing, I'm actually doing, and I'm posting this. And I've got timestamps in my chat room. And there you can see added to VXX, log VXX 2617. So I'm just buying the underline because I haven't done many swing trades. I haven't had the guts to be bearish overnight. I'm catching all the moves day trading anyway, so why would I need to carry an overnight? But at this juncture, I saw this as an absolute bargain because option implied volatilities still have not increased because nobody believed that this selling pressure was for real. And I believe that there are a lot of people who are short option implied volatilities, and they are going to get squeezed when the market takes its next leg lower, which is going to be this morning. We're going to see the next leg lower, and we're going to see option implied volatility spike. I think that the 200-day moving average could be in shot in range in the next 2 weeks or so. So if you are trading from the long side, boy, you should have already taken these warning signs, and you should not have a lot of bullish exposure. So the ultimate setup that we will see is a big washout where we get a gigantic drop down, and it will be gut wrenching. It will feel like the market's never going to have an uptick ever again, and it'll happen in the first 2.5 hours of trading. And then all of a sudden, buyers will come in, and they'll come in with a vengeance, and it will be a long green candle, long green candle, long green candle, long green candle, and those erases will be lost instantly, and you'll be left with a gigantic bullish hammer like this off of a major moving average, closing above that major moving average. That is the type of price action that asset managers will get behind. Will they get behind this for the next month or 2 or 3? They could. It really depends on the backdrop and how China's credit problems play out. All I can tell you is that from a trading standpoint, if I see that type of formation, I am going to buy, and I will at least hold overnight, probably the next 3 days, because that is a major support level that will be bought. Now, if things start to settle down and I start to see all those gains preserved, I will start holding on to that position. I may even add to that position. I don't know how things are going to play out right now. Stay fluid. Know that valuations are really, really stretched. Know that inflation is on the rise. Know that there are credit concerns that are looming in China, credit concerns probably in other areas of the world as well. It's October. This is typically a weak month for the market. That's all I've got for you today. I like VXX. It's going to spike this morning. Look for an entry point on VXX. I think this is a longer term position that you can have until we test that 200-day moving average. When you get that big washout and that air pocket that feels like there's never going to be a rally ever again, that is when you want to exit your trade on VXX because you're going to see a gigantic spike on it. And those spikes typically don't last long. So you go from here, which was 64 to 86. Nice move. Take your profits, get out of that trade. I hope this helps you with your trading. We'll see you tomorrow. Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.